expected and the unexpected. We often confuse these two because, well, it's easy to do. When does the unexpected become the expected? At some point that transition occurs, but it can be incredibly difficult to pinpoint. In this confusion of expectations, it ends up hurting a lot of investors, even those that view themselves as the exception. And currently, our society is experiencing a shift in expectations, which can be both seen and experienced virtually everywhere right now. At the gas station, the grocery store, the shopping mall, it's impossible to miss. Inflation. But the real question is, what do you do about this inflation? What do you do about this change in expectations from low inflation to high inflation? You maybe have some cash that's protected from market risk in your bank account, but you know that every day that goes by, you're likely lighting a larger number of dollar bills on fire to inflation. You can protect yourself from the dangers of the road, but you're still burning gasoline by idling. So what do you do about it? The media and the financial world, being well aware of your fears, they're pretty good at that. They're proposing a number of different inflationary hedges, everything from gold to stocks to real estate to commodities to cryptocurrencies, the list goes on. But what actually constitutes a hedge? What makes a hedge a hedge? And is that hedge in your best interests? Today, I want to help you with that. And we'll do that by examining 10 different popular inflationary hedges. Again, this word hedge, it comes up all the time, but nobody seems to define it. So what we'll do first is define what an inflationary hedge is. Then we can take these supposed inflationary hedges and see if they're actually an inflationary hedge. Of course, all of this is with the intention of educating you so you can figure out what should I do and what makes sense for my world. My name is Michael McKelvey, and I'm a certified financial planner with Mariner Wealth Advisors. So what's different about us? Well, we're a national wealth advisory firm that provides not only investment and wealth management services, but tax planning and preparation, estate planning, trust services, and a host of other solutions too. We're a full-service firm. We've been ranked by Barron's as a top 5 RIA for the previous 6 years because of this comprehensive advice. And if you're ever just curious, how does this all pertain to my own situation? What should I do for my own world? Maybe you feel like you just need a guide. You can feel free to click the link down below or in the description here, and you can schedule a complimentary consultation. And as always, make sure to hit that subscribe button to follow along for more content from industry professionals here at Mariner Wealth Advisors. For now, let's jump to it. So inflation is everywhere. And that means that it's baked into stock prices, it's a part of wage agreements, and you go negotiate your salary, you talk about it. And without getting too much into things, remember that a stock price, that's determined by taking the future sum of cash flows for a company, discounted to a present day rate using what's called a discount rate. And this discount rate will assume some expected rate of inflation. So what does all that mean? Well, it means that a stock price will account for some expected rate of inflation in its valuation. But what about unexpected inflation? That is when inflation exceeds expectations. How do these various asset classes, these different inflationary hedges perform with unexpected high inflation? This is where the disconnect happens. Not only for investors, but a bevy of financial representatives as well. So I want to make sure that you understand the difference. And first, what we need to do then is define what an inflationary hedge is, or at least what you should want from an inflationary hedge. So first, it needs to positively correlate with both high expected and high unexpected inflation. Second, it can't be too volatile. It can't have really too much up and down, otherwise it succumb to volatility risk. And third, it needs to be accessible. It can't have too much liquidity risk in case you need money in time of need. And lastly, it needs to outpace inflation. That's what we're trying to do here in the first place. It's not much of an inflationary hedge if it's not outpacing inflation. So, given these metrics, we'll look at each of these 10 inflationary hedges by first describing what it is that they are, and then also analyzing how do they hold up under these parameters. And we'll start with perhaps the most coveted, shiny inflationary hedge that seems to be talked about: gold. Gold has a lot of unique spellbinding characteristics about it. It's rare, it doesn't corrode or break down over time, and it looks pretty cool, as we already talked about. It's shiny. And as a result, it's embedded into our society's perception as valuable. And because of this strong reputation, gold is often perceived to be a safe investment, an inflationary hedge. But is it? Or at least is it given the other alternative options from an investment standpoint you might have? To understand this, let's look at how gold holds up under our first hedge test. Does it positively correlate with both high expected and high unexpected inflation? Well, kind of. According to a research paper, which I found quite interesting, it's called The Golden Dilemma. Gold had a relatively low positive correlation with high inflation. It was really only over extended periods of time that you saw much of a correlation at all. In this case, a century. Anything less than that, any time horizon shorter than that, there's too much variance to really conclude any correlation at all. It's hit or miss. For example, if you take the price of gold and you chart that against CPI, the common measurement for inflation, you'll find that the price of gold swings far more dramatically than CPI. And even worse for gold, it did not really correlate with high unexpected inflation. There was even less of a correlation with high unexpected inflation. Still, it's hard to look past gold's high returns during the 1970s, which might just be more of a result of President Nixon's policies than anything. But it does seem to perform quite well during recessionary periods of time, at least during the onset of a recession. And one unrelated note, gold seems to enjoy fiscal stimulus. Money printing seems to positively affect the price of gold, which makes sense theoretically. You're putting more money into the system, it would affect other asset classes. But all of this, it's hard to look past the lack of intrinsic value for gold. Its price is essentially determined just by what people are willing to pay for it. And you might say, well, that's true about stocks and real estate too. I guess, but it's a little bit easier maybe to see the value of a company which a stock represents or a piece of real estate people will need a place to live than it is an element being gold. Some other notable points on gold as an investment. So it's taxed as a collectible, and that means a top rate of 28% versus the traditional 15 or 20% you'd find with most other investments for a long-term capital gain, that is. So you can pay more in taxes if you're realizing a gain, and hopefully you're realizing a gain in a taxable account. Otherwise, what's the point of the investment? Second, there's storage costs of owning gold. Unless you just want to keep it in a box in the garage, you probably have to keep it in a vault maybe, and there's costs to doing that and protecting it. So there's that added cost. Additionally, you have to insure gold typically if at least you want to hedge that risk of someone taking your gold. Or you can maybe just wait and say, I don't want to do that, but there's an obvious risk there. And you might think, well, I'll just get around all that by owning the fund or some index fund that just invests in gold or whatever it might be. These traditional, these collectible funds, they have to pass down these costs to investors some way. Usually that is. And they do that through what's called an expense ratio. A lot of times collectible funds, gold funds in this case, they'll have a little bit higher expense ratio because they're passing that on to the investor. So you're not necessarily getting fully around it. In that case, you want to pay attention to maybe what expense ratios are there if you are investing in a gold fund. But these are all notable pieces when you're thinking of gold as just an investment in general, in addition to just, hey, I want to have an inflationary hedge. You shouldn't be short-sighted on just having the inflationary hedge. It should be, how is this a part of my whole portfolio if I'm considering investing in it? So how did gold hold up against our inflationary hedge tests? Well, unfortunately, it did not satisfy all of them. It failed a few. The first of which being it did not positively correlate with both high expected and high unexpected inflation, enough for us to be okay with it at least. Maybe over a long period of time, cited by the Golden Dilemma paper, a century in this case, we saw a little bit of correlation, but anything shorter than that, not enough to say, yeah, this is a true inflationary hedge under all expected and unexpected high inflation environments. The second, it was quite volatile, so it also failed this test. Its price swung quite dramatically. Third, it did have some liquidity. If you own it within a fund, you can access that fairly easily. Now, if you own it personally, if you have the bricks in your house, you maybe have to go through a little bit more to sell it. We'll say that it does satisfy that requirement from a liquidity standpoint, at least in this case. And lastly, it does outpace inflation quite significantly in the long run. So it did have a real expected rate of return that was positively higher than the traditional CPI. So that's a benefit. And all of this isn't to say that you shouldn't consider it as a part of your entire portfolio or a part of your financial plan, but in this case, it did not satisfy the inflationary hedge test. Real estate is another asset listed as an inflationary hedge, and it certainly has reason to be given its long history of outpacing inflation. So real estate right now is enjoying a supply issue, which is caused by a number of different effects, but that's helping jack up its price to all-time highs. In addition to this, though, during high inflationary periods, REITs, real estate investment trusts, and landlords, they can increase the rent for tenants, which can help buoy real estate as an asset against inflationary periods of time, high inflationary periods of time, that is. But real estate is deceptive as an asset. It's deceptive in an interesting way. It's deceptive because of its tangible nature. You can walk in it, you can touch it, you can quite visibly see that it is indeed an asset. And this maybe helps develop an emotional connection. Is an emotional attachment beneficial to investing? Maybe this helps you invest in real estate. That's a good thing, but it can obviously cloud judgment. And coupled with its ability to be a leveraged asset, this is real estate's greatest challenge, while simultaneously being its biggest benefit. That's why it's always fascinated me. So all of this isn't to say that real estate shouldn't be considered as a part of your portfolio. It's a powerful asset. Everyone should consider it. But to consider it an inflationary hedge, that might be financially crippling to you. A quick lesson in correlations. From 1963 to 2007, the average home price steadily increased with few exceptions. And if one was looking at all this data and say 2006, they might conclude, yeah, real estate is inflationary proof. It's recession proof. But the problem with correlations is they aren't, say, a physics law. They can quickly change. And we are all aware of what happened from 2007 to 2011, the Great Recession. All this data, all this growth, all this correlation is both an inflationary hedge and a recession-proof asset suddenly imploded within months. And inflation was present, 2008, 2010, and 2011. But real estate didn't go up like inflation did during those years, so that makes real estate not a perfect inflationary hedge, at least under our circumstances of what a hedge is. But ask yourself, would you really want real estate to be an inflationary hedge, a perfect one? You might not get all that growth along the way if that's the case. If it was correlated to inflation 1-to-1, well, then you'd get what inflation got, which means you wouldn't outpace inflation in the long run. So you maybe don't want something that's perfectly correlated to inflation. This is why part of the reason it's so hard for an asset to be an inflationary hedge, because it has to be positively correlated to both forms of inflation, and it needs to outpace inflation in the long run. So you maybe wouldn't want that out of a growth asset because you wouldn't get all the growth. This is why mentally accounting for real estate as an out-earn hedge is a far more sensible approach than a perfect inflationary hedge. That way, you won't be as disappointed maybe at some point in time. Additionally, real estate is very localized. So just saying across the board real estate is an inflationary hedge would be like saying every single stock is an inflationary hedge. And that sounds funny when you say it, because obviously there's stocks that don't work out. There's real estate that doesn't end up being a good investment. And this has always been a challenge for real estate, right? So when you own a piece of property, it's a single type of property, typically in a single city, in a single state, in a single country. Not exactly diversified. So, we'll never be averse to real estate as a part of one's overall plan because it can be such a great asset, whether it's personal properties or real estate investment trusts. Those are REITs in this case, which allow you to passively invest in real estate without having to put in the time. And then also you can also get quite a bit more diversification that way at a lower entry point, that is. Now, how much real estate one should hold, what types of properties or real estate they should consider is obviously going to be highly subjective to each individual. Treasury inflation protected securities. If there's ever an asset that sounded like it hedged against inflation, the Treasury nailed this one. TIPS are Treasury bonds that will pay interest twice a year by way of coupon. But unlike other or most Treasuries at least, their principal will also adjust with inflation as measured by Consumer Price Index. If one were to look up current TIPS interest rates, you might be a little confused, because if you go to Treasury Direct, the government's financial services website, you see 0.125 in certain places, and then negative interest rates in others for TIPS. Might be a little confused. So here's what's going on. The Treasury Department, they don't feel quite comfortable yet rolling out the negative interest rate. So instead, you pay a premium for a bond. You pay more for a bond because you're getting more interest than you theoretically should, which unfortunately means you automatically fail hedge test number 4, having a positive real return. So TIPS, while they do a pretty good job being correlated with inflation because their principal will adjust with inflation, regardless of if it's expected or unexpected, they can also struggle in a variety of ways of just keeping pace with inflation given the circumstances right now, right? So, while TIPS do track both expected inflation and unexpected inflation, they might fail to outpace it. So they pass that first test, but they maybe fail the last. Now, TIPS, they can be accessible. You have to hold them for a few days to start. It's a period that you have to hold on to them, but they can be sold before maturity. So there is some liquidity there in the secondary markets. And from a volatility standpoint, they're decently volatile, depending on how you're purchasing or investing in TIPS. Keep in mind, you can invest in different TIPS ETFs or funds and gain exposure to them, but there's underlying risks there that are involved that maybe aren't involved with just owning them outright. I would say the biggest being you can't hold the TIP until maturity and essentially insure yourself at least the principal in return. So a lot of considerations, but not a perfect inflationary hedge. Given their propensity to outpace inflation in the long run, stocks are often considered a good inflationary hedge. Now, anytime we're thinking of investing in stocks, we have to remember that we're investing in businesses. And good businesses will continue to serve a need even with a devaluing currency, something that might cause inflation for a country. Stock short-term volatility, that obviously is going to limit them from being a true inflationary hedge, at least with the terms that we laid out. But number 4, hedge test number 4, their real rate of return has outpaced inflation, a well-diversified portfolio that is. Even if you just used the Dow Jones Industrial Average or the S&P 500 as an index, both of those have outpaced inflation in the long run. However, one important distinction that for some reason gets overlooked in the realm of stocks, even though it's relatively straightforward, there are different types of stocks. I know that's probably groundbreaking, but within each type, there are further subsets. This gets consistently downplayed through these sweeping statements like, well, value stocks, those are a wonderful inflation hedge. What value stocks? Are we talking international or domestic? Are we talking large cap or small cap, mid cap, industrials, financials, what sector? So There's, really challenges in speaking this broadly. It'd be like saying, well, all US businesses perform well in an inflationary environment. It's hard to get through that without chuckling, right? So, rather than go through this flawed question of how do stocks perform during inflationary environments, because it's so broad, it'd be like saying, how do all businesses perform in an inflationary environment? Well, that's kind of difficult to answer. So rather than do that, I want to point out just a few different insights around stocks during inflationary periods of time. Now, there is some evidence to show that value stocks do better than growth stocks, broadly speaking, during periods of high inflation. But keep in mind, these spikes are primarily during periods of high unexpected inflation. That is when inflation exceeded expectations. So for example, in 2022 here, you might say, I think inflation is going to be higher than average. You might feel like a contrarian for that. You feel good about that. Yeah, this is a stance I think is going to happen. Well, that's not unexpected. In fact, if you look at market sentiment, the easiest way to do this is just look at our current Treasury inflation protected securities and just seeing, okay, what inflation rate are they baking into their account? You'll find that it's higher than average. So the question is, will there be unexpected inflation beyond this already high expected inflation? Difficult question to answer. So if anything, this is just really the case to own value stocks as part of your portfolio. The question, of course, is how much, is that percentage making up of your entire pie? But in 2021, it was all about growth stocks, technology, right? Value stocks were for old guys. That's not something we're interested in. And then everything changed here in 2022. So value stocks against our 4 inflationary hedge tests. Number 1, there is some positive correlation with unexpected high inflation, but not enough with expected high inflation to really justify a pass on that. Number 2, value stocks can still be volatile, so I'm going to say that they don't necessarily pass that piece. Number 3, most stocks are considered liquid. Now, obviously, it depends on each stock. It depends on maybe the funds you're talking about, but in broad terms, stocks are considered to be fairly liquid assets. They're marketable assets. Number 4, value stocks have had a positive real rate of return. They've outpaced inflation in the long run, so they get a pass there too. International stocks are another form of an inflationary hedge, and it makes sense because, well, countries don't move together in tandem fiscally. They're different from one another, but home country bias is a very real thing. That is, investors tend to skew their investments towards the country that they live in. They invest within companies where they live. And although the almighty dollar maybe has a large impact on the world, there is quite a bit of empirical evidence that suggests that a globally diversified portfolio is beneficial for investors. So while global stocks are far from being perfectly correlated with inflation, either expected inflation or unexpected inflation, which means they fail that first test, there is significant grounds to show that they decrease volatility risk in the grand scheme of your entire portfolio. And of course, there's different types of international stocks. So this can be broken down into even further subsets, but speaking broadly, they can help from a diversifier standpoint, which, if you think of a time where maybe there's a devaluing US dollar, not every other country is going to experience the same devaluation of their own currency at the exact same time. So it can help buoy that inflationary risk, but it's more from a diversification standpoint than a true hedging standpoint. There is a guaranteed government bond that is currently paying over 7% interest. I-bonds. I-bonds are 30-year government bonds that have both a fixed interest rate, currently 0%, and an inflation-adjusted interest rate, currently 3.56% semi-annually, which is over 7% annually. So that's pretty dang good, actually. So how are they doing this? In fact, that's really good. How are they doing this? So if the Fed is able to curb inflation, which historically it's been able to by jacking up interest rates and doing a host of other things, then the inflation interest that you get on I-bonds will likely come down. If inflation comes down, that number would consequently come down. But if inflation goes up, then that number would go up. So this is likely to be a case where you wouldn't necessarily get this high inflation, over 7% in this case, rate for the rest of the 30-year bond. It would be probably not a great scenario if we had inflation at those rates for 30 years, but that doesn't mean that you shouldn't consider I bonds, even if this rate is likely to come down, especially if you maybe don't plan on holding them to maturity. So what else do we need to know about I bonds? Well, you have to own them for at least a year. And if you redeem them before you own them for 5 years, you pay a 3-month interest penalty. And so they're unlike TIPS in that way. They're also unlike TIPS in that there's no secondary market. You would just go redeem your bond, right? So you don't sell it to any individual person or broker in this case, right? They're also unlike TIPS in that you're limited on how much you can buy annually. But all this isn't to say that I bonds shouldn't be considered as a part of one's portfolio, especially, again, considering the other guaranteed alternatives that are available right now. Some other notable benefits of I bonds: you don't have to pay any state or local income taxes on the interest received. You also potentially don't have to pay any federal income tax if that income, or the bond in this case, is used for higher education. You could potentially not have to pay any taxes at all. That's a pretty big benefit. So how do I bonds stack up as an inflationary hedge? Well, if we think of our 4 tests, the first being, do they positively correlate with high expected and high unexpected? Yes, they do. It passes that. They also pass the second test because they're not terribly volatile. They don't have a ton of volatility risk because there's no secondary market, so they pass that test. The third and fourth tests are where I bonds start to struggle. So they're not terribly accessible. They kind of have some liquidity issues because, well, you got to make sure you hold it for at least a year. And if you redeem them before 5 years, you pay a penalty and interest. So they're not terribly accessible. I would say that's something you want to be concerned with, not something that's a complete game changer, but obviously something you want to be aware of. And that makes them less liquid than a lot of other alternatives. And finally, the fourth test: if the fixed interest rate is 0% and you just have the inflationary interest rate, well, then you know you will never outpace inflation over the 30-year period of time because, well, you're only getting what inflation is getting. So you are guaranteed to just keep pace with CPI. So they're going to struggle to outpace inflation in that case. In fact, you're guaranteed that they won't, at least as a barometer of CPI. So I bonds, maybe you own them for a year or two and you say, yeah, it's fine if I pay the 3-month interest penalty, and you take advantage of this high inflation rate that we have right now. Maybe you do that. But they're not necessarily a true inflationary hedge. 1.2 trillion. That's how much passed with the infrastructure bill here in 2021. And with that came a flurry of new infrastructure investments, or at least a flurry of new infrastructure investment pitches, investing in real assets. They love this word, real, as if, when you're investing in other things, they're just ideas. It's not typically the case, but the idea here is using a catchy phrase that tells a story, and infrastructure has, I think, a pretty good story. You're investing in physical structures or systems, right? So roads, highways, different government projects, ones that you can see, tangible ones. And the idea here is this could be an inflationary hedge. And we'll go over that in a second, but that's, again, the question. How does infrastructure hold up as an investment? How does it hold up as an inflationary hedge? Well, there's a little bit of a challenge with infrastructure in that it hasn't been around that long as an asset class. At least we don't have a lot of data on infrastructure as its own asset class. So there's somewhat of a challenge there, but there's reason to believe that it has done okay during periods of expected and unexpected inflation. The reason for that is these contracts, they have clauses within them. So these different infrastructure projects, which are either completely government or government and private projects, they have these clauses built in that can help protect against high rates of inflation. So if the price of some good that's being used for the project goes up substantially, then there's a clause maybe that helps protect within that project against that in some way. So it's easy to understand they might do a little bit better during those periods of time. In fact, a BlackRock study was quick to point this out, but they still seem to have lagged behind real estate and, just broadly speaking, stocks as far as their real returns over long periods of time, which, again, we don't have a ton of data on. So Infrastructure is a difficult one to evaluate, but I would say that it's absolutely one to consider as a part of your portfolio, given the rise in infrastructure over the last decade. Short-term bonds and money markets. So historically, short-term bonds, either by way of short-term bond funds or just owning the short-term bonds individually, and money markets, they've been a way to keep pace with inflation. But interest rates, they've been pretty low lately, and inflation, well, that's been pretty high. So hasn't been the story as of late, but one of the benefits of short-term bonds is as they come due, you can reinvest them into new short-term bonds. And if interest rates are rising, well, then your short-term bond rates should theoretically be rising as well. So this can be one way to combat inflation, but by no means a true inflationary hedge, because as we mentioned, test number 4, outpacing inflation, have a positive real return. That's pretty difficult to do right now. It's been pretty difficult really the last 5 to 10 years. But short-term bonds, they don't have a ton of volatility, and obviously they don't struggle tremendously from an accessibility standpoint. Same with money markets because they're fairly accessible. They're short, right? Or if it's a money market, you can just get the money out typically fairly quickly. And they seem to positively correlate in some way with high inflation, in that interest rates like to fight inflation. We typically raise interest rates with high inflation. That's not a perfect correlation there, but still, this is all the reason to at least have some holding place maybe for your cash, especially as interest rates are starting to go up now. Maybe consider some money markets or more short-term bonds as a part of your portfolio. Commodities. Commodities are basic goods that are largely interchangeable. They're essentially uniform in that case, right? So 1 bushel of wheat could be interchanged with another bushel of wheat as long as they meet a minimum standard. That's why they trade on an exchange. Gold, silver, bushels of wheat, coffee beans, natural gas, crude oil, sugar, corn, beef, livestock. These are all examples of commodities, which makes evaluating commodities as an inflationary hedge fairly challenging because those are obviously different things. One would not confuse coffee beans with livestock, but technically these are all commodities. So again, just saying that commodities are an inflationary hedge, it's kind of like saying value stocks are an inflationary hedge. We need to be a little bit more specific than this. But if we just evaluate commodities from a return standpoint, check out these variance in returns. Those are some pretty big differences, but we're still going to proceed here, even with that disclaimer of evaluating commodities as an inflationary hedge. So commodities, they're basic goods. So it makes sense with inflation going up, that basic goods would also go up. And when you look at their correlation to stocks and bonds, it's sometimes very low, if not negative. And that sounds like a good thing. Hey, I have a non-correlated asset to stocks and bonds. Until you remember that most of the time stocks historically have been up. Most years they've been positive. So that might mean that you might not have a positive return with your basket of commodities, which is the case here for the last decade, at least up through 2021. So that's not typically great for hedge test number 4 of outpacing inflation if we just have a negative rate of return in the first place. Something to consider. Now again, all different types of commodities, we're doing our best just to broadly evaluate them here, but we want to make sure we understand, well, what are we actually getting from a return standpoint and not just how are we hedging against inflation. Additionally, if you're investing in commodities, you're probably doing so by owning a fund, an ETF or a mutual fund, unless you have a vault in your home for your precious metals, or maybe a warehouse refrigerator, or a grain silo out back, or maybe a petroleum reserve. If you don't have those things, then you probably have to invest in a fund. And these funds, well, they're typically buying commodities by way of futures contracts. And unfortunately, futures contracts, they're not the most inexpensive things in the world. So these commodity funds carry higher expense ratios a lot of the times. It's another knock on commodities, unfortunately. They can be expensive. All of this means that, unfortunately, commodities, they don't necessarily pass our inflation hedge tests. They maybe do correlate somewhat with high expected and unexpected inflation, but their challenges really lie with, well, they do still have volatility. And at the same time, they haven't shown great returns over long periods of time, even long periods of time. So I would not say that commodities are a true inflationary hedge, even widely speaking, doing my best here. Investing in other countries' currencies as an inflationary hedge. So it makes sense theoretically. If you live in the US and your whole life is kind of built around this dollar, if you invested in other countries' currencies, if the US dollar devalued, if it fell in value, then theoretically you would help hedge yourself against inflation. The problem with that is, what about when the US dollar goes up relative to these other currencies? And this is really what the data has shown, is that there's not a ton of information as to whether this really helps decrease risk or increase risk. One caveat with this, if you're investing in foreign global stocks, you are helping at least invest in other types of currencies. So you do get a currency diversification in that way in some form, but it's really difficult to evaluate this one because there's just, again, not a ton of data on it. But at least from what we have, I can't really say that it's an inflationary hedge. On this note, cryptocurrencies too, they've been touted as an inflationary hedge. Obviously, they haven't been around that long, so it's difficult to, again, really see them as an inflationary hedge. And in this last few years, Bitcoin, it certainly hasn't been positively correlated, although that's just one cryptocurrency in the whole gamut of things. It hasn't positively correlated with expected or unexpected inflation. So it's difficult to say if cryptocurrencies as well can be a true inflationary hedge. Bonus round. Number 1, spend less. Number 2, substitution effect. Maybe consider shopping at Safeway instead of Whole Foods, or buying in bulk instead of buying individually. Thank you for joining the bonus round. So, unfortunately, the perfect inflationary hedge might not exist, but there's still a question of how do you balance yourself amongst all of these different asset classes? How do you weight accordingly within your own personal plan? And for a lot of people, they feel like they need a guide with that. So if you have questions, or maybe you just want to connect, you can feel free to click the link down below in our description here to schedule a complimentary consultation with either myself or one of our advisors here at Mariner Wealth Advisors. And also make sure to hit that subscribe button to follow along for more content from us moving forward. Take care.